Welcome back to the course Introduction to Commercial Banking and Fintech, and in this particular course we are talking about the Basel III regulations, and we have already explained in the last session that how the banking system has evolved. So let's focus on the deeper side of the Basel III regulation, and we also discussed this particular slide in the last session towards the end. So let's focus on the capital adequacy ratio. So capital adequacy ratio, it is basically the ratio of total capital, both tier 1 and tier 2 upon the risk weighted asset. So it is also one of the I would say risk and loss observing buffer that here we have. What is the purpose? That it makes you understand that whether the bank remains solvent or it is going for insolvency. So given the macroeconomic shock or the systematic shock that the bank is getting, or you can say systemic also shock the bank is getting, whether it will remain solvent or it will become insolvent. So it talks about that, and this is where it is very important. So I mentioned that if the total regulatory capital both tier 1 and tier 2 for a particular bank is 1500 crore, so and the risk weighted asset given the loan portfolios or the exposure portfolio of the bank, which is around 10,000 crore, which means that bank is able to maintain, so up to, so it can, out of total exposure of 10,000 crore up to 1500 crore, bank will be able to maintain, because this is what it has, and up to 1500 crore worth of shock it can bear. But if it is like 3500 crore or 4000 crore, then bank will have to look for borrowing or maybe going for recapitalization request from the governments. But CAR gives the internal financial stability condition, and we can see that despite the evolution of Basel II, Basel III, CAR remains a relevant indicator. What has happened that in Basel III we have added the counter-cyclical buffer to that, right? So this is what here we have. So minimum capital ratio 8%, capital conservation buffer that here we have, it's 2.5%, so effectively it is 10.5%, right? And if India implements a minimum CAR of 9%, and if they are going to have the capital conservation buffer of 2.5%, here we have effective RBI is 11.5%. So this is what here we have. So emerging market macroeconomic volatility is this. Second thing is about it is also talking about the credit risk, that how we are going to deal with, and again about the systemic risk vulnerabilities that bank is going to see, and how the potential regulations are also going to shape further, right? So this is what it implies. Let's have the capital buffer. Let's think in terms of loss absorption. Suppose a bank has a capital of 1200 crore. It has the risk weighted asset of 10,000 crore. Then we know that the CAR is going to be 12%, right? Now, if we have 600 crore worth of loss occurring, so bank suppose experiences the loss of 600 crore, maybe in the form of NPA crisis, that bank is not able to get money back, whatever money it has lent, so whatever its exposure. So new capital is going to be how much? It is going to be 600 crore. Now you can see that your new CAR is just 6%. It means that here you are able to comply of 9%, but here you are not able to comply, right? So you are not able to comply, which means that here you will be in trouble. So which means that if the CAR falls below minimum requirement, it means that you will have to think about raising capital or reduce asset, which means that you go for lesser exposure because loan is the asset for the bank, or central bank will come into and you will have to go under supervisory supervision, which means that some intervention will be there, maybe in the form of prompt, you can say corrective action, which means that we have a PCA kind of analysis. And it also mentions that it also shows the importance of maintaining adequate capital buffer. So this was the requirement, that if bank is going to see sudden shock, right, and it gets accumulated within a week, then how the bank is going to react, and if it doesn't have the sufficient capital buffer, then they will have to undergo either asking other bank or asking the government or they're asking the central bank, or they can go by having the less exposure. Maybe they will not be issuing fresh loans to the even good borrower, that we have seen already, good borrower and bad borrower, and this is how it creates the overall check. And this is also one of the reasons for the need for capital buffers. So overall banking system that we see, that for public sector banks it is around 15 to 16%, for private sector banks it is 17 to 19%, and overall banking sector it looks more favorable, right? So this is what we get. We also find that the CAR basically it gives you a good amount of credit and market shocks based resilience. The confidence of the depositor investor improves, and this creates a whole lot of a good sense on the financial stability of the bank. And then also you can think about how you can sustain any kind of macro shock. So these things are interlinked. These things are, you can say, a macroeconomic understanding. So macroeconomic dimension that we touch upon, right? So this is what here. Now let's think about how Basel III, that we have going concern to gone concern. So common equity tier 1, it is the going concern that we have already seen. So total capital in the case of the Basel III in terms of the loss absorbing capacity that we have, it goes by tier 1, tier 2. So tier 1 we know that it includes common shares that the bank has, retained earnings if it has not declared any dividend, disclosed reserves if they have whatever amount they have, and net of goodwill deductions, so goodwill, deferred tax, etc. And this is what is the first step for loss observing, right? So when we have the in terms of hierarchy, the tier 1 comes number 1. Then here we have the additional tier. In tier 1 only, here we have a common equity tier 1 plus additional tier 1. Additional tier 1, perpetual instruments with no fixed maturity. It means that if you are going for any kind of long-term bond investment or perpetuity means in the sense that you are also having the non-interest income, you have invested in stocks or something and you have a continuous dividend and return, so that those are called perpetual instruments. Can absorb losses through write downs and conversion during stress, so this is could be, right? And higher risk and higher yield. So basically if you have any kind of exposure which is linked with the perpetual kind of income, then this is what it comes down. In tier 2 capital, which is more linked with the subordinated debt and the other long-term instruments, and it also links to the resolution or failures, so which means that the tier 2 capital is the gone concern. So overall tier 1 is the CET1 plus the AT1. So this is what here we have tier 1. In tier 2, here we have the mostly subordinated or risk related capital, which means that it is going for the loss provisions. So tier 2 are mostly quite on the risky side as compared to tier 1. So under Basel III, how regulatory capital absorbs losses, which means that how it can be considered. So here we have the loss absorption order. So if you have like bank experiencing a huge losses, then how it will deploy the capital. So first deployment will be in the form of common equity tier 1. So this is what here we have, the common equity tier 1. Second deployment would be in terms of the additional tier 1. So tier 1, so common equity tier 1 plus additional tier 1. So additional tier 1 will be put into. Then last you will have the tier 2. So this is how it looks like. So I have also tried to give one example. For example, sequential loss observation. So here we have the initial capital structure is, suppose common equity tier 1 capital is 800. So tier 1 800 plus 200. So tier 1 is 1000. So 1000 that we are seeing, and tier 2 is 300. So total capital is going to be 1300. Stress scenario, the credit losses that we are assuming that for the bank it is 900 crore. So how you are going to deploy? So first will be the CET1 that bank is going to deploy. So it will be 800 crore, followed by 100 crore you will be picking up from the additional tier 1. So this is what here we have. So remaining loss is 0, and tier 2 will remain unaffected, will not be utilized, right? So this is how the risk absorption or sequential loss absorptions looks like, right? So this is what we often get into. Suppose we have again the CET1 500 crore and additional tier 1 is 200 crore and tier 2 is 300 crore, and loss shock we are assuming 700 crore. So you can see that first 500 to 700 it has gone already. So tier 2 will remain untouched, and additional tier 1 basically protects the depositors and senior creditors, because this is what it looks like in terms of perpetuity and other things. But if you are thinking about how a bank manages the risk when they see a bank run kind of scenario, so this is how the order looks like. So this is where it is very, very important to highlight. Now here we have the input and required Basel ratio. So for example, if I have to calculate under the Basel III norms that how, so if we have the CET 700 code, AT 1 is 100 code, and tier 2 is 200 code, and risk weighted asset is suppose 8000 code, and total exposure is suppose 18,000 crore, then how do we calculate the major ratios? So the common equity tier 1, it is going to be 700 upon 8,000. Then tier 1 ratio, it is going to be CET1 plus 81 upon RWA. Total capital ratio, because it is tier 1, so this is what here we have at tier 1. So here we have a tier 1, and this is what here we have tier 2. And leverage ratio is how much? What we have the CET1 plus 81 upon the total exposure. So this is what it also tells about. So this is how we get. So if I have to calculate this, so here we go for CET1, so it is coming out to be 8.75. Tier 1 capital, we know that CET1 plus 81 is the tier 1 capital, so it is going to be 800. So tier 1 ratio total is going to be how much? So though common equity tier 1 is 8.75, but then we have 8100, so this adds to 10%, right? So this is what we have here. So total capital, if I have to calculate, so CET1 plus 81 plus tier 2, so it is going to be 700 plus 100 plus 200, so 1000 that here we have. And total capital ratio is how much? It is going to be 12.5%, which means that if you are having the exposure of 18,000 crore, then you have a total exposure of 12.5% of 8,000 crore, and this is what it implies, that you can go for that kind of risk weighted asset scenarios, right? So this is how it helps understand. And if I have to calculate the leverage ratio, so tier 1 capital is nothing but CET1 plus 81, right? So it is coming out to be 800, 700 plus 100, here we get 700 plus 100, so 800, and this is the total exposure. So if you calculate that, so your leverage is going to be 4.4%. So given your total exposure, how much you have the common equity tier 1 to absorb, so tier 1 capital plus the additional tier 1 that here we have. So bank has tier 1 capital of equal to 4.4% of total exposure, which means that up to 4.4% or maybe 4.5% of the total exposure, if there is a shock arising, then it can bear the risk. Otherwise, it will have to go for capital raising, or maybe some kind of potential supervision, or maybe going for some kind of intervention that so leverage ratio provides a safeguard when RWA may understate to risk. It means that bank can go for having the risk adjustment with regard to the total exposure, and this is where it plays very, very important role. So this is how we get into. Now the another important part is that while leverage become important, and in the Basel III, if you read the literature or even if you go through the newspaper, you find that the leverage term has become one of the controversial topics that we'll be discussing in the later part. And I have also read that how regulators are also not very much comfortable. So for example, they can have the same bank can show, so while leverage matters even when CAR looks strong, so same bank can show comfortable RWA base ratio while carrying substantial leverage, which means that tier 1 upon the total exposure. So if for example, if the exposures are concentrated in sovereign holdings, RWA may remain moderate to total assets. So this is what here we have, right? So your risk weighted asset in CAR, we have the capital upon the total capital upon the risk weighted asset. So risk weighted asset may change because of the sovereign holdings that, or maybe any kind of exposure that asset investment that you have. But whereas exposure is the overall exposure, so this may increase, and as a result your leverage gives you the better picture. So risk weighted captures regulatory risk, not necessarily a tail risk or the valuation risk, but it leverage basically considers. So in case of non-financial firms that we often discuss, so in non-financial firms the leverage is debt upon equity, right. Now if higher the debt, you have higher leverage. So highly leveraged firms are called highly risky. So it means that, or you can also go by, if the company is not listed, so you can also go by debt upon total assets. So total debt, let me just write it down here. So here we have the leverage. So total debt upon total assets. Now if I have to get this number, so it implies that it is showing that if it is higher, your overall leverage ratio is going to be higher. If this is higher, then overall leverage ratio is going to be lower. So it basically it talks about the risk characteristics, so riskiness of the banking system. So and this is where it plays very important role to understand. So here in this case, what we have done in the case of banking sector, when we calculate the leverage, so in the case of banking sector it becomes tier 1, because this is the financial banking is the financial institution, and upon the total exposure, right. So this is this difference you should always remember. A leverage for the non-financial institution, which is total debt upon total asset or total equity, whereas in case of financial institutions it becomes tier 1 upon the total exposure, and this is where it becomes important. In case of financial institutions, non-financial institutions or non-financial companies, if you have a leverage ratio more than 100% of your total asset, it means that you are highly risky. In the same way, here we can think about, if the total risk exposure is greater and your tier 1 capital is lower, then it creates a more it means that lower is considered bad, higher is considered better, right. So this is what it implies here, right. So tier 1, I hope we have solved this. Now here we are also showing that suppose we have the stress scenario we are putting here. So stress shock and the ratio deterioration, that how these ratios come. So suppose loss shock of rupee 400 crore absorbed entirely by CET1. So now you have new CET1 coming out to be 300. Now here you can see that in the case of CET1 ratio, it is 3.75%. Tier 1 ratio, because 100 is the 81, so 81 will be capped, and this is the CET1, right. So it is 400 upon 8,000, so it is 5%. And leverage ratio, you can see that it is 300 plus 400, 18,000, so it is 2.2%, right. So which means that if the bank is having the 400 crore of immediate loss, then of course it will be absorbed by the common equity tier 1, because it is a small amount which they already have the 700 crore of tier 1, and we know the deployment of waterfall that we discussed, which means that with this deterioration of capital, bank is also going to see the fall in the regulatory ratios, and even the leverage ratio is going to also fall, and this is where it becomes important. So earlier in the previous case, we were able to see that it was a 4.4%, right. But now 400 crore of credit loss, we are seeing that it has come down further, right. And higher it is better, because if the numerator is higher, it means that bank is having lower leverage. If the numerator is lower, it means that bank is going to have it is riskier for the bank. So lower values are considered as riskier. So leverage ratio can deteriorate rapidly, signaling vulnerability even before risk weights, and this is what we often imply. So this is what we get here. We are now going to touch upon an important topic, which is about why Basel III were introduced and why leverage ratio became part of the Basel III. So as I mentioned that global financial crisis paved the way for introducing different types of capital ratios, and especially the strong ones for the banking sector given the risk weighted assets. So under Basel II, the capital ratio depended mostly on the risk weights, which were mostly model based. Second thing is that the bank could increase the total bank balance sheet size while keeping reported RWA relatively low, because they had to maintain the capital adequacy ratio. So there was no indicator that can measure the total exposure based indicator, right? So it was just the risk weighted asset upon how much you have the capital one, so tier 1 and tier 2 capital, and once you meet 9% or if you have 11% is all okay. But here it is about total exposure, that how much you have the tier 1 capital which is going to deploy at first go, and with respect to total exposure how much is the percentage. If it is higher, you are healthier, you are less risky. If it is lower, then you are more riskier, and this is where the Basel II was silent on this. A structured product and sovereign exposures often carried low regulatory risk weights. For example, if the banks are getting a lot of incentives, or even if the government is incentivizing banks to invest in those kind of derivative based products, then it may create trouble later, and there will not be any kind of cushion for the bank if they are going to experience any loss, which means that outside the banks looked well capitalized, but when they experienced the shock, it became big, unbearable, and it also turned into some kind of systemic risk. There are two arguments for this. One is that leverage ratio, it is simple, transparent, and it is less likely that a bank can be able to manipulate, because it is just the tier 1 upon the total exposure. It also provides the protection against the what we have seen in case of Basel II. Then it also have the balance sheet expansion kind of, that how much we have the tier 1 capital. So this if you are increasing the tier 1 capital, then you don't have to worry about expansion of your loan assets, because if the tier 1 increasing sufficiently, then you can go for having higher exposure. And it also having the robust macro level safeguard to take. But the demerit of this is that it has been criticized for having a low risk and differentiation between the low risk and the high risk asset. And it also shows that if we are focusing more on the denominator, right, on the exposure, then bank may be they may become risk averse, and they may be choosing more government oriented assets than this, and may conflict risk sensitive capital regulation. So this is also one of the important dimensions that I touched upon. So suppose how this can be manipulated. So here we have, suppose how leverage can be hidden under RW framework. So here it's, so consider two banks with identical tier 1 capital of rupees 500 crore. So total asset is 500 crore, right, and RWA is 4,000 crore. So CAR is going to be how much? So here we have the total capital, which is 500 upon 4,000, so it is 12.5%, and leverage is going to be how much? So your tier 1 capital is 500 and your total assets is 5,000 crore, so it will be on, so total asset is nothing but it is called total exposure, because loan is the asset for the bank. So this we can think about, so it is 10%, right. Now bank B has a total exposure of 20,000 crore, right, and the risk weighted asset is 4,000 crore due to low risk weights, which means that your CAR is going to be 12.5%, leverage is 2.5%. So here you can see that with the same amount of tier 1 capital that the bank has, leverage ratio is changing significantly. For the first case, it is 10%, which is looking like low risky, whereas in the case of bank B, which has the more exposure of 20,000 crore, we are seeing that with the same tier 1 capital, bank is reporting less of leverage, and this is what it implies. And here we are also seeing that with the same RWA and the total capital, which is having a tier 1, the CAR remains same in both cases, but leverage is showing you the clear picture that leverage is changing considerably, and this is where it becomes really important to note and understand. So this is where it becomes important. So here you can see that it is the tier 1 capital upon the total exposure. So it is so it becomes important for the regulator also to request the banks to monitor this exercise and do it, and it also complements in a big way the risk based capital ratio, and this is where it becomes really important for all of us to get into. So overall, what looks like that the leverage ratio gives you better picture, and that's why it became controversial, because banks found that it may impact their overall risk taking scenarios, because if the government is, or if the central bank is more concerned about the leverage ratio, which means that they will be think about the total exposure, so they will be also trying to reduce, or maybe adding only those assets which are less riskier. So as I highlighted earlier, that in the balance sheet the bank may be thinking to add the dimension of having the total exposure linked to the investment, and this could bring a lot of structural change in the banking system, and they may be also thinking about making investment into technology and other items, internal supervisory systems. And so Basel III indirectly forcing the banks to take small steps to monitor well your exposure, and then try to have the better CET value, and then based on that they can create the better leverage scenario, and for the regulator also it becomes easier. And I have mentioned already that overall it basically deals with the systemic risk scenario, that even though the bank is able to fulfill the capital adequacy ratio, but on leverage side it is looking riskier, and this is where the regulator can chip in and can request the bank to get into. So this would be the last slide for this particular session. So Indian and global experience, if you think about, so several major banks had a leverage ratio below safe levels, which means that at least you should have around 8 to 10% or more than 5%. High leverage amplified losses and triggered insolvency risk. So this was also reasons. One of the reasons could be that you have high leverage ratio, and if you have a credit shock coming in, then you may not be able to control yourself, and ultimately you will have to go for excessive borrowing. Governments were forced to recapitalize banking system in case of NPA crisis in India during 2016 to 18. We experienced, and we also saw that the merger of the banks were done because the reasons of the total exposure versus how much absorptive capacity they have, which is in terms of tier 1 capital. RBI implemented Basel III leverage ratio as a supplementary safeguard. Indian banks have the maintain leverage ratio above minimum requirement that they have to think about, and as per the industry standards, the leverage ratio should not be so high, otherwise it will be showing that bank is keeping the not taking that much risk, and it is also maybe in certain new sectors bank will be encouraged to make investment. So maybe that is not for good for the economy. Banks are forced to comply with those kind of standards. So 5 to 10% is okay. Conservative capital regulation helped limit systemically instability, and this is what. So leverage ratio complements RWA, right, risk weighted capital, and strengthens the overall financial stability. So with this, I hope in this particular session that we discuss different dimensions of the Basel III, and we touched upon how CAR, risk weighted asset, the common equity tier 1, additional tier 1 capital, tier 2 capital, and the waterfall situations, how banks have to deploy. In Basel III, the leverage ratio has become important topic, and this is what we discussed, that how it plays very important role, and it has better revealing pattern than the CAR. With this, I am stopping it here. I appreciate your attention. Thank you so much.